Thank you very much. Hello, my name is Charlie Moran. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Nathaniel Ekman and Alan House. Today, we're going to provide an update on the economy and stock market. We will then recommend one stock to buy right now, and finally, answer any questions you may have. Please note that this presentation will be available on our website, valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE. Now let's discuss the economy and the stock market. This content was prepared by Value Line's economic staff. The final 2023 readings on consumer and producer prices painted a mixed picture on the state of inflation. True, the reports did not change the narrative that inflation is on the gradual downward trajectory, but getting to the Federal Reserve's target growth rate of 2% will not be easy. On point, J.P. Morgan Chase's Jamie Dimon, head of the nation's largest bank, recently noted that inflation remains sticky and interest rates may need to be higher than markets expect. Stubbornly high inflation was seen at the consumer level. The December Consumer Price Index rose 0.3% on a month-to-month basis and was up 3.4% over the last 12 months, both higher than expected. Conversely, the PPI Producer Price Index fell 0.1%, was up just 1% over the last year. Given this varied data, the Personal Consumption Expenditures Price Index, the PCE Price Index, the assessment of inflation most closely tracked by the central bank, will be a key data point ahead of the next Federal Open Market Committee meeting. The Federal Reserve may not be in a rush to reverse monetary policy course. Indeed, despite forecasts on Wall Street for an interest rate cut as early as this March, several senior Fed officials have stated that federal funds rate may need to stay high for longer to effectively fight inflation. Our stance is that a reduction to the benchmark interest rate will not come before the second half of this year. The Fed's actions will likely be dictated by the state of the economy. The current consensus is that a soft landing is still plausible, especially given the tight labor market. That said, there have been some signs of economic strain, including a decline in December manufacturing activity and sharp downward revisions to prior month estimated job gains. Fourth quarter earnings season got off to a decent start with a number of big banks delivering solid profit growth. Solid results from corporate America may be needed to justify elevated stock valuations. In conclusion, in an environment where rates remain elevated and fourth quarter corporate earnings growth is not likely to be as formidable as the prior period, we think a portfolio consisting of high-quality stocks and cash is a prudent investment choice. On that note, Value Line provides a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line offers a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's valueline.com. I will now show you how to access those reports. Once signed in on the website, head to the dashboard where I am already located. This is the main landing page for subscribers. Under the quick links, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Due to the changing structure of company balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength, along with price stability, another proprietary Value Line measure, are the two metrics that are used to calculate a stock's safety rank, a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Now we will go to the intro to the screener and our one stock to buy right now. Let's move on to the one stock to buy right now. For this, let's go to the screener. Value Line subscribers have access to 15 preset screens and 50 fields for screening stocks. I should also mention that another 100 or so fields are available and require a higher level of subscription. If that interests you, please call 1-800-VALUE-LINE. As noted in our economic analysis, although there are some tailwinds, much also remains uncertain. As such, we'll be looking for stocks with a better than average risk profile and strong return potential over the long term. We'll start the screening process by looking at the safety rank in the ratings and ranks section. And we're going to go to the safety rank and look for a 3 rank or better. There are many risk measures to consider, but today we're going to start by applying our time-tested safety rank. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale from 1 to 5, with 1 being the most conservative issues. I want to highlight the fact that stocks ranked above average for safety have in the past held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. We're going to focus on stocks with a 3 or better rank, and by applying that first criteria, we've trimmed away our potential candidates down from 5,700 to, I believe, 2,062. Okay, the second filter. Now we're going to filter for timeliness, one of our tried and true measures. Timeliness is a proprietary value line metric that evaluates a stock's projected price performance in the coming 6 to 12 months. Like safety, it's a straightforward scale from 1 to 5, with 1 being the highest. Today, we want a stock that will outpace the overall market over the short term. So we're looking at stocks ranked 2 or better, and by applying that screen, we've trimmed the list to, I believe, 296 candidates. You can see there on the right. The third filter, we want to look at the target price range over the next 18 months. The timeliness rank measures a stock's likely performance over the next year. We also want to extend our view and look at likely performance over the next 18 months. We are using a filter of 20% or better on this screen. And to put things in perspective, the median 18-month appreciation potential is currently under 15%. Applying this filter, we have reduced our opportunity set to 81 stocks. The fourth filter that we are going to use is the projected 3 to 5 year annual percentage total return. We will change gears and focus on stocks with a high total return of 20% annually or more. By applying this criteria, we've cut the list down to, I think, 34 candidates. Yep. And fifth, next, we will focus on companies with market caps below $5 billion. After a long period of underperformance, small cap and the lower end of the mid-cap companies started to outperform in the fourth quarter of 2023. They've endured a bit of a pullback in the first few weeks of 2024, but we think that a case can be made for incorporating smaller cap public stocks in portfolios, especially now that valuations have come in to a large extent. And by applying this filter, we get our final 10 stocks. You can make a strong argument for any of our remaining candidates, and investors interested in adding new positions should consider them all. However, only one can be today's one stock to buy right now, and after consulting with a number of our senior analysts, we prefer and recommend Mercury General, ticker symbol MCY. Before I click on MCY, please note that screens can be saved and revisited by utilizing the Create Save Screen button at the top. And let's look at our last full-page report. Mercury General, still logging in. We got it here. I believe this was written in December. Mercury General is an insurance holding company that writes commercial and private passenger insurance as well as homeowners insurance. Nearly 84% of 2022 premiums were written in California, and it is the fourth largest auto insurer in the California market. As you can see in the statistical array, which is the area in the center of the report that includes the financial data, premium growth should continue to rise while expense to premiums written stabilizes at around 16.5%. Losses to premiums earned are expected to revert lower slightly. All in all, we expect $1 in earnings per share in 2024. The stock was hurt by an unusually large combined ratio in recent quarters due mostly to unique factors such as hurricanes and weather-related problems, but auto insurance claims did pick up. The company applied for rate hikes, and California regulators appear to have awarded sizable increases to a number of personal auto rates, some as high as 21% to 31%. And although some rate decisions were announced on January 17th, as of January 10th, the state was still reviewing 75 auto insurance rate change requests. It is interesting to note that consensus earnings per share has been rising on Wall Street in recent weeks, and the average earnings forecast now for 2024 is $1.95. This had been a contentious issue in California, and State Farm and Allstate agreed to write insurance, having threatened to pull out of the market if relief was not granted. The company has a financial strength rating of B+, but is not covered by many sell-side analysts. This contributes to its low score for earnings predictability, and it does have a fair amount of risk. It is also levered, but not unusually high. The debt-to-capital ratio is 29%, and the stock's dividend was cut in 2022 when the company's profits slipped into the red, but the payout is still rather generous. Mercury has a long established track record, having served California since 1961, and the dividend yield is now 3.5%. Overall, we think that Mercury General has worthwhile recovery potential and offers solid total returns for those who can tolerate a bit of risk. It is today's one stock to buy right now. We will now tackle your questions. Please note that I typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few questions were submitted prior to this presentation, and now I'll hand it off to Nathaniel and Alan.
Thanks so much, Charlie. So getting into our questions, we have one question from a subscriber who says, I'm trying to transition away from growth stocks to value stocks. Does Value Line offer recommendations for dividend aristocrats with 20 years of consistent and increasing dividends? To that, we actually have an entire product, our dividend and income growth product, which is entirely focused on those sorts of stocks. So if that is something that interests you, we strongly recommend that you check out that product. I've got another question here. How are changes made to safety ratings? I can't get into too much detail about how our proprietary ranks are assigned, but we do regularly review all of the companies that we cover, and we do have an internal process for assigning those ranks. So we check those regularly. One stock to buy. At the end of the screen, there are several stocks that result from the screen. How do we determine the best of the group? We talk about that internally. Those of us on that are here on the webinar today with you and a few other people within the company. There's a whole approvals process that we go through for these stocks. So they're chosen from that list quite carefully. Let's see.
Nathaniel, I see another question about the combined ratio. I know Charlie alluded to that. As far as Mercury General's combined ratio going up in the past, several quarters, and a subscriber was maybe a bit concerned about that or questioned that, and that's actually commonplace in the insurance industry right now. 2023 in particular was a difficult year for insurers. There was a lot of weather-related catastrophes. That trend has been going up overall in recent years, but like everything else, some years are worse than others, and it just so happens that 2023 was a particularly bad year for that. So a lot of companies had a higher combined ratio. So the higher combined ratio is not good news for profits. The higher the combined ratio, the lower the net income. But on the flip side of that, just to maybe paint a silver lining, is that it does generally give insurers, greater bargaining power during the renewal policy renewal cycle of the following year. So 2024 policy renewals should be higher based on the increased loss exposure from last year. So that's why, we're more optimistic regarding 2024. And as Charlie alluded to, a lot of analysts are beginning to raise their estimates for this year for the company. Thanks.
Mm-hmm. All right. Let's see.
And Nathaniel, I just wanted to mention, Nathaniel mentioned the dividend income and growth product, and it is an excellent service for investors seeking dividend income and growth. And just to expand on that a little bit, that we do have a featured pick and alternative pick each month for that publication, and we do have supplementary reports on all the featured selections when they report earnings. So it is a good service. At the present time, we have about, I think, 14 featured stocks and about 12 alternatives. So it does give a good mix of stocks to pick from that offer above average dividend income growth potential.
Mm-hmm. Yeah, yeah. And that's just one of several more specialized, services that we have. As was mentioned in the presentation, the mainline investment survey is our flagship product, but we have a number of others that are focused on, specific issues or investment strategies, which also offer, monthly stock recommendations that are different from the ones that we give here. For example, we have the mergers and acquisitions service. We have the climate-focused investing service. There's a wide variety if any of those might appeal to your particular interest.
Thank you. And along those lines, someone did ask if the one stock to buy right now webinar relates to any of those services as far as the stock pick. And the answer to that is it does not. This is independent of those other publications. As Charlie alluded to, we come up with a one stock to buy right now on a monthly basis. We dwindle the list down to about 7 or 8 or 9 names, and there's an intense discussion about what stock should be the one stock to buy right now, but it's not included in any other publication. It doesn't coincide with that. Just wanted to address that. Thanks.
Mm-hmm. Yeah. You seeing anything else that you see any other questions that jump out at you, Alan? Today?
Well, someone was saying the difference between, long term and a short term, and they mentioned 1 year. And, that's actually a really good question. And I guess there's no concrete, hard answer to that. But I would say that, anything under a year I would say would be short term. Anything
Mm-hmm.
1 to 3 years, 1 to 2 years, I'd say 1 to 2 years would
Yeah.
be considered, I would say, intermediate term, and then anything like 3 to 5 years, I would consider longer term. So when we speak of short-term gains, long-term gains, short-term is usually within the next year, which is our timeliness ranking system is based on, whereas long-term gains we're looking at 3 to 5 years, and like one of our screens in this particular webinar was the 18-month price appreciation potential. And that was something we began probably about 7 or 8 years ago, because there are a lot of investors that look, at stocks on an intermediate term basis. They want to,
Mm-hmm.
maybe they're saving for college or retirement, or
Yeah.
they, whatever. They just want to maybe invest for a few years, and then they, maybe want to take it out or roll it over, what have you. So that's why we institute the 18-month target price range for those investors.
Yeah. 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 Like Alan said, there's no hard and fast definition where you can say, well, after exactly this much time, we're moving from, short to intermediate or intermediate to long. But, sort of internally, Usually, if we're talking about short term, we're looking at the timeliness rank. Intermediate, we're looking at the 18-month. Long term, we're looking at the 3 to 5 year projection.
And I'm sorry, go ahead, Nathaniel.
Oh, I was just saying in general, because again, there are always, specific situations and, you know,
Gotcha.
yeah.
And one of our, I just wanted to, one of our screens also was the 5 billion under market cap. And, for our purposes, we look at anything under $2 billion is small cap, 2 to $10 billion is mid cap, and $10 billion and above is considered large cap. I mean, I think a lot of people have their own concept of what's, small, mid cap, and large, but for value line purposes, that's what we use. And being that we were looking at 5 billion and under, like Charlie alluded to, we're looking at the small cap and maybe the lower end of the mid cap range, which is where the 5 billion and under falls into.
Yeah. And, I did see in our questions, someone was, asking, well, okay, why look at, companies, that small? And the answer is that a lot of the time with those smaller names, that's where you can find a lot of opportunity, right? And so, like, size isn't everything. What you want is often, a good business model, efficiency, and potential for growth. You don't necessarily want it to be huge already, because then that's kind of where everyone is, right? A lot of the time.
I also see another question that pops up about the timeliness ranking system. That's a proprietary measure, so I can't get too in depth about what it's included in that. But it is momentum is one of the factors that we look at in there. So there's other variables involved, but there's definitely a momentum aspect of that. So. That's just one of the factors, that's into there. But, like as I said before, timeless rank measures the year ahead performance or the next 6 to 12 month performance for the stock. So, on a scale of 1 to 5, with 3 being right around the average. So a stock that's ranked 1 or 2, we think it should outperform the market in the year ahead based on our ranking system.
Mm-hmm. Yeah. I'm not seeing anything else that I think we can really address in this session. Are you seeing anything, Alan?
I think maybe just one more that just popped up is someone asked about investment income per share, and there's concern. I guess a lot of insurers invest. A lot of their profits are in their investment portfolio because, especially during years like last year where there was a lot of losses incurred, so they look to generate funds from their investment portfolio. And most of them are predominantly fixed income, and bond yields have been high of late, right? They've been high of late, which has been helpful, for companies like insurers that invest in fixed income securities. And I guess the question is, will that hurt? If the Fed does lower rates, will that hurt? Their investment portfolios? And I don't think I think I don't foresee that much, that much of an impact in 2024. I mean, like our our economist doesn't think there's going to be rate cuts until at least, the second half of this year, and there's always a lagging effect when that happens as well, because portfolios, they have to reinvest the dividend proceeds, from the bonds. I'm sorry, the coupon payments from the bonds. So the reinvestment rates probably aren't going to take much of a hit this year. And you're also probably going to see, higher premiums this year, which is going to, result in an increase in invested assets. So I think net, there's probably not going to be too much of a drag on investment income for property casualty insurers this year. 2025 could be a different story, but I don't have a, crystal ball to look that far ahead yet, but
Mhm.
a lot of it depends on what the Fed does. And, our position right now is that I know some, analysts and economists are looking for a cut earlier, but I mean, we don't foresee one until at least the second half of this year. So
Mhm.
thanks.
All right. I guess I do see one more question, which was, if a stock price drops 25% in a week, would you still rank it 1 for safety? Now, like I said before, I can't get too in-depth on how the actual ranks are assigned. Like I said, we do review safety ranks regularly. In general, those are going to be changed when we issue a new report on a company. So if something happens between reports, it'll be reflected in the next report. However, when something happens with a company between reports, as we showed earlier in the presentation, we will issue a supplementary report on that, and that will go to you right away. So even between reports, you'll always be kept abreast of what's happening with the companies that you're choosing to follow through Value Line. Um, um, and I think that's it for us, Alan.
Yeah,
Uh,
let's, thank you all for joining us. I'll turn it back to our producer, Tim.